In March 2021, one private investment firm collapsed so fast that some of the world's biggest banks lost billions before they could fully react. This was not a famous hedge fund. It was not a global bank. It was a family office called Archegos, and behind it was one man, Sungkook Bill Hwang. Using leverage, derivatives, and Wall Street's own financing, Archegos built a hidden stock market empire. Then, in just a few days, that empire disappeared. This is the story of Archegos Capital Management. Before March 2021, most people outside finance had never heard the name. But inside Wall Street, Archegos was an important client. It traded with some of the world's biggest banks. It generated fees, it took large positions, and for a while it looked like a brilliant success story. But here's where it gets interesting. Archegos was not simply buying stocks in the normal way. It was using financial contracts called total return swaps. These contracts allowed Archegos to get the economic return of stocks without always appearing as the direct owner of those shares. That detail matters because it meant one firm could build huge exposure across several banks while the full picture remained hard to see, and when the market turned, that hidden exposure became impossible to hide. Bill Hwang was not new to Wall Street. Earlier in his career, he worked with Julian Robertson, the legendary founder of Tiger Management. Later, Hwang founded Tiger Asia, an investment fund focused on Asian markets. But in 2012, Tiger Asia and Hwang ran into serious legal trouble. Tiger Asia pleaded guilty to wire fraud, and Hwang settled with regulators in relation to insider trading allegations. For many people, that might have been the end. But Hwang came back. He transformed his operation into a family office called Archegos. A family office is different from a normal hedge fund. A hedge fund usually manages money for outside investors. A family office manages the wealth of one person or family. That can mean less public disclosure, less outside scrutiny, and more privacy. For Archegos, privacy became a powerful advantage. By 2020 and early 2021, it was building huge exposure to a small group of stocks. The names included ViacomCBS, Discovery, Baidu, Tencent Music, and other media and technology companies. To the outside world, these stocks seemed to be rising because investors loved them. But behind the scenes, Archegos had become a very large force, and it was buying with borrowed firepower. To understand Archegos, you need to understand one thing: the total return swap. The name sounds technical, but the idea is simple. Imagine you want to profit from a stock, but you do not want to buy the stock directly. So you make a deal with a bank. If the stock goes up, you receive the gain. If the stock goes down, you take the loss. The bank gives you the economic exposure and you post collateral. That is the simplified idea of a total return swap. For Archegos, this was extremely powerful. It allowed the firm to control very large stock exposure using less upfront cash than direct ownership. It also made the positions less visible than normal shareholding. And because Archegos traded with several banks, each bank saw only part of the story. One bank saw its own exposure, another bank saw its own exposure, but nobody had a perfect picture of the whole machine. The problem was hidden in plain sight. Archegos was not just taking market risk, it was creating concentration risk, leverage risk, liquidity risk, and counterparty risk, all at the same time. On the way up, that looked like genius. On the way down, it became a trap. In 2020 and early 2021, some of Archegos' favorite stocks rose sharply. ViacomCBS was one of the most important examples. As the stock price climbed, Archegos made more money on paper. The rising prices made the positions look stronger. The bank saw a profitable client, and profitable clients are hard to challenge. That is one of the uncomfortable truths of finance. When a client is making money, producing fees, and growing fast, risk warnings can feel like interruptions, but the warning signs were there. Archegos was concentrated in a small number of stocks. It was using leverage. It was relying on several banks for financing. And if the same positions started falling, everyone would want to exit at the same time. That is where liquidity becomes dangerous. Liquidity is the ability to sell without moving the price too much. In calm markets, liquidity looks abundant. In a panic, it disappears. And Archegos was about to discover that the hard way. The turning point came in March 2021. ViacomCBS had surged, then announced a large stock offering. The market did not like it. The share price started falling. Other Archegos-linked stocks also came under pressure. Suddenly, the same leverage that had helped Archegos grow started working in reverse. The banks asked for more collateral. These were margin calls. A margin call is simple. The lender says, Your position is losing money. Send more cash or we will start reducing the trade. For a small investor, a margin call is painful. For a massively leveraged family office, it can be fatal. Archegos could not meet the calls, and this is where the story turns. The banks had a brutal choice: wait and risk bigger losses, or sell quickly before everyone else sold. Some banks moved faster and reduced their exposure. Others were left holding much larger losses. As banks sold large blocks of shares, the selling pressure hit the market. Prices fell. Falling prices created more losses created more selling, and the loop became deadly. By the time anyone reacted, it was already too late. Archegos was finished. The collapse was brutal. Archegos had built enormous exposure, with later reports and legal filings suggesting well over $100 billion in gross stock exposure. When the positions were unwound, banks suffered more than $10 billion in combined losses. Credit Suisse was hit especially hard, with losses of about $5.5 billion. Nomura lost around $2.9 billion. Morgan Stanley, UBS, and other banks also reported losses, although some firms moved faster and limited the damage. For Wall Street, the shocking part was not just the size of the losses, it was who suffered them. These were sophisticated global banks. They had risk systems, they had committees, they had experienced teams, they had models, limits, dashboards, and escalation processes. And yet, a private family office had created one of the biggest trading disasters in recent memory. So the question was obvious: how did nobody stop it earlier? After the collapse, Archegos became a symbol of hidden leverage. Regulators looked more closely at family offices, derivatives, disclosure rules, prime brokerage, and counterparty risk. Credit Suisse published a major internal review. The report pointed to serious weaknesses in risk management, escalation, supervision, and culture. In plain English, warning signs existed, but the organization did not act strongly enough, fast enough. Then came the legal consequences. Bill Hwang was charged by U.S. authorities. In July 2024, he was convicted of fraud and market manipulation charges connected to Archegos. He was later sentenced to 18 years in prison. Patrick Halligan, Archegos' former chief financial officer, was also convicted and sentenced to 8 years in prison. Recent reporting says both are appealing and free on bail. That matters because the legal story is still not completely closed, but the market lesson is already clear. The lesson of Archegos is simple but uncomfortable. Risk does not disappear because you hide it inside derivatives. Leverage does not become safer because the client is rich. And a position is not diversified just because several banks finance different pieces of it. Archegos showed how one private firm could build enormous exposure in public markets while the full picture remained fragmented. It also showed how incentives can quietly weaken discipline. The banks wanted a profitable client, Archegos wanted more exposure, the market rewarded momentum, and as long as the trade was working, the risk was easy to tolerate. That is how many financial disasters begin, not with panic, not with headlines, but with rising prices, growing confidence, and a warning sign that everyone thinks they can handle later. By the time later arrives, the exit is already crowded. If you want more untold stories of market crashes, famous trades, hedge fund disasters, and Wall Street scandals, subscribe to Wall Street Untold Stories. Because behind every billion-dollar loss, there is a decision. And behind every decision, there is a story.